Last month, I made $74,504 using my liquidity-based trading strategy. And in this video, I'm going to show you the exact trades I've taken. I'm going to show you my entire strategy, how it works, and I'm going to walk you through real-time examples so you can see exactly how I did it. Just look at these results. This isn't some get-rich-quick scheme. This is a proven, data-driven approach that I've been using consistently for the past 4.5 years. Most traders fail because they trade based on emotions and gut feelings instead of following a systematic approach. They look at charts and they just guess where price might go next. But successful trading is not about guessing. It's about understanding where the big players, the institutions, the banks, the hedge funds are placing their orders. And that's exactly what my liquidity-based trading strategy is going to teach you. Once you understand liquidity, you're not just going to be randomly entering trades hoping for the best. You are going to be trading with the smart money, not against it. So you are going to be entering at the exact levels where institutions and hedge funds are accumulating or distributing their positions. In June, I took 11 trades and I did not take a single loss, meaning my win rate was 100%. But I want to make this very clear, guys. I take losses all the time. My win rate is about 70 to 75% on an average, but I had a really good month without any losses. So just know that and understand that. And my average risk to reward in the month of June was 1 to 4. This means for every $1 that I risked, I made back $4 in profit. That's why it's okay if I take a loss from time to time, because my average risk to reward is so high. So my winners are so much bigger than my losers. My biggest day in June was June 9th. I made $10,815 and I was only trading for about 2 hours. So it felt really nice to work a little bit and make this much money. We definitely had some choppy days throughout the month. So there were a lot of days where I looked at the markets and I decided to just not take any trades, which is actually a really good skill to have because so many people want to just rush into trades. But when you have that discipline, you're able to have these big months without any losses. I have to make sure that I'm not taking stupid losses because I want to just force trades. So discipline is something you need to have as a trader. The beauty of this trading strategy is the consistency that it has. I wasn't gambling. I wasn't taking massive risks, hoping for home runs. Every single trade I took followed the same systematic approach, looking for the same liquidity patterns that I'm about to show you. So what exactly is this liquidity strategy? In simple terms, we're identifying areas where large institutions have placed significant buy or sell orders. These areas act like magnets for price. When price approaches these levels, we see explosive moves as these large orders get filled, just like we saw right here when we had a beautiful bounce off of this London low, and I actually took this trade, which I'll go into a little bit later in this video. This strategy focuses on 3 key components: session opens, previous highs and lows, and liquidity grabs. Every morning, I mark out specific levels using my session range indicator. Then, I wait for price to interact with these levels in a very specific way. First, let me show you the technical setup. I use the Asian Session Range Indicator by Rob Minty. You can find this on TradingView for completely free. All you have to do to get this indicator is you have to click indicators right here, then you have to type in Asian Session Range by Rob Minty, and I'm gonna go ahead and show you guys my settings real quick just so you can make sure you have it synced up to the right time zones. I'm in the Eastern Standard Time zone, so make sure that you guys understand that, and here are all of my settings real quick. I'm gonna scroll through this. You guys can feel free to take a screenshot. These are really the only 3 sessions you need to know: London, New York, and Asia. So these are the start and stop times. That's all you guys need to know. You guys can mess around with the colors as you see fit. Let me walk you guys through some actual trades from June to show you exactly how this strategy works. I'm not gonna show you guys every single trade that I took, but I'm gonna show you pretty much all the trades that you need to know to help you understand this strategy. Here is my first trade of the month. I took this trade on June 3rd, and this trade was actually a beautiful break and retest of the New York Open. The first thing that we do before we even look for this trade is we mark out the first 15-minute candle of the New York Open right here, right? So that's called the New York Open zone. Once we have that zone marked out, we then look for a break above the zone. I like to look for this on the 1 minute. When we get the break above, we're looking for a retest, right? So once we get the retest, we enter longs. I usually wait for price to reach this midpoint right here and then start reversing a little bit so I have some confirmation that price is going in my direction. I then enter longs, and that trade specifically, I caught about 17 points and I exited right at that high, which was another area of liquidity. That was my first trade of the month, and on that specific trade, I made $3,400, which was a nice way to start the month. Now I'm going to show you guys an example of a break and retest setup to the downside so you can see how this works when you're taking shorts. Right here, we have the same exact level marked out. First 15 minutes of the New York Open, 8 a.m. And mind you guys, this is the New York Open of the stock market, right? So this is when the volume starts coming in early in the morning. Remember guys, this is not the stock market open. The stock market opens at 9:30 a.m. and that's usually when I start taking trades around, but I get my level from the 8 a.m. market open, which is when the Forex session starts and the volume starts coming in from Forex. Just like so, I have my New York Open zone marked out. Once I have the zone marked out, I'm then looking for a break below. I get the break below, and then On this trade, I actually waited for us to sweep this high because I wanted us to sweep the high before I entered. We swept this high, which also gave me some signs that we were probably going to reverse because we had a nice little rejection off of that high. I then entered shorts right when I saw price start to reverse on the 1 minute time frame. I got out right at that low for a nice risk reward of 1 to 3.5. On that trade, I made $4,930 and I caught a risk reward of 1 to 3.5. Now I'm going to go over my biggest day of the month, and honestly my biggest day in a while. I made $10,815 on this day and I took 2 trades, so let's talk about them. The first trade that I took was a nice bounce off of London low. I made $4,250 on this first trade. This was a very, very simple trade, guys. So all I was doing was I was waiting for price to bounce off of this low, and I had a limit order right at this low. I told myself if price came down and swept this low, I expected a reversal pretty fast. So I set my stop loss right here for a nice, really, really tight stop loss, minimal drawdown trade, and I made $4,250 off of that one. The next trade I took, and I actually want you guys to pay really close attention to where I put my stop loss in this trade, was a break and retest to the downside. So you guys can see that we have a London high right here. As we just talked about, highs and lows are key areas where price likes to reverse. So I knew that. So what I did is I entered this trade right at the midpoint and I set my stop loss slightly above this high because I thought that price would sweep that high, taking out some people who had their stops right at that high. So I placed my stop 1 tick above, guys. That's a little trick that you guys can do. If you see an area, for example, a high or a low where you think that price might reverse, don't put your stop right at that area. Put your stop either, 5 ticks or a few ticks below or above that area to give yourself some breathing room. So this was my second trade, guys. I sized a little bit heavier on this trade because I already had a winning trade for the day. So I made about $7,000 off of that trade, bringing my total profit to $10,815 after fees. This was a day where I did not take a single trade. I know you guys see me winning with the big profits, but some days I just sit back and I say, you know what? I don't like the way the market looks today, so I'm not gonna take a trade. And I'm going to show you guys exactly why I didn't like the way the market looked. When I'm marking out my New York Open, I like the range to be smaller than 15 points. If the range is bigger than 15 points, this means that my stop loss will have to be super big, meaning I probably won't have an ideal risk to reward on whatever the trade is that I'm taking. Wednesday was a perfect example of this. So on Wednesday, June 11th, we had a giant New York opening range. So I already knew that I was not going to be looking for any break and retests, and I saw that we were chopping around a lot. So I didn't take a single trade, guys. I didn't like how we were chopping around. I didn't like that we didn't have any direction. And most importantly, early in the day, I did not like how big that New York open range was. This strategy works because it's based on market structure and institutional behavior. It's not based on emotions or gut feelings or silly little drawings. But to really understand why it's so powerful, you need to understand the psychology of the different market participants. Most retail traders think in very predictable patterns. They see a breakout above a previous high and think, price is going higher, I should buy. They place their stop losses just below support levels because that's what every trading book tells them to do. This creates massive clusters of stop orders at obvious levels. Here's the thing, these stop orders become liquidity for institutions. When you place a stop loss below support or below a low, you're essentially placing a market sell order that will trigger when that level breaks. Multiply this by thousands or even millions of retail traders all doing the same thing, and you have massive liquidity pools sitting at these obvious levels. Now, institutions, hedge funds, banks, and large investment firms, they need to fill massive orders. If a hedge fund wants to buy $100 million worth of an asset, they can't just market buy it all at once. That would push price up dramatically, which means they would have to pay millions of dollars in slippage because price would be way higher than they want to buy in for. Instead, they need to find liquidity. And where's the best place for them to find liquidity? Right where all of these retail stop losses are clustered. So institutions will deliberately push prices to these levels, trigger all of the retail stop losses, and use that liquidity to fill their positions at better prices. This creates what we call a liquidity grab. This is when price sweeps above a previous high or below a previous low, triggers all the stops, and then immediately reverses. The institutions got their fill, and now price moves in the direction they actually want it to go. Most retail traders see this as a fake breakout or a stop hunt, but it's not malicious. It's just how the market works. They need liquidity, and retail stop losses provide that liquidity for them. This is why traditional technical analysis often fails. Support and resistance levels, outdated indicators, trend lines, chart patterns, these are visible to everyone. When everyone sees the same thing and acts the same way, it creates a very predictable behavior that institutions can exploit. This liquidity strategy works because instead of following the crowd, we're anticipating where the crowd will place their orders, and then we position ourselves to benefit when institutions come to collect that liquidity. Think about it this way. If you're playing poker and you don't know who the sucker at the table is, you're probably the sucker. In trading, if you don't understand where the liquidity is, you are the liquidity. But when you understand these concepts, you completely flip the script. Instead of being the retail trader whose stops get taken out, you become the trader positioned on the right side when these stops get triggered. Let me show you guys a clear example with a real-time trade that I took on June 4th. So you guys can see right here that we have this London high. Most traders had their stop loss right at this London high. So when price hit this high, they got stopped out. But me personally, I knew that this was going to play out. So what I did is I put my stop loss slightly above this high, so I had some breathing room, and I was still able to catch these shorts. The institutions were able to get their shorts filled right here because all of this retail buying pressure from these stops getting hit gave them enough liquidity to get into that move down. We're able to make such consistent money from this strategy because patterns like this will repeat themselves every single day. Human nature does not change, guys. Retail traders will always place stops at obvious levels, and institutions will always need liquidity to fill large orders. That's just how this thing works. Understanding this dynamic gives us a massive edge because we can anticipate these moves before they happen. Now that you have a basic understanding of liquidity, let me show you what separates the 99% of traders who lose money from the 1% of traders who actually are profitable. Most traders only look at price action, where price has been, but successful traders look at order flow, where the orders are. Price is just the result of order flow, not the cause. When I'm analyzing the market each morning, I'm not just looking at support and resistance. I'm looking at where orders are likely to be resting. Previous day highs and lows, round numbers, session opens. These are all areas where orders cluster around. Here's something that most traders do not understand. Liquidity grabs often create cascade effects. When stops get triggered at one level, it can cause price to move to the next liquidity level, triggering more stops, which moves price to the next level, and so on and so on. This is why we sometimes see these explosive moves that seem to come out of nowhere. It's not random, it's liquidity cascading from one level to the next. Another advanced concept is understanding liquidity on multiple time frames. The daily high might have liquidity from swing traders, but the 4-hour high might have liquidity from day traders, and the 1-hour high might have liquidity from scalpers. When these levels align, you get what I like to call a liquidity confluence. This means that multiple groups of traders all have stops at similar levels. These are the highest probability setups because when you have multiple sources of liquidity at the same area, you have a lot of confidence that this is an important area. Risk management is absolutely critical if you want to see success with the strategy, but it goes a lot deeper than just setting stop losses. Let me break down my complete risk management system for you right now. I call this rule the 1% and beyond rule. I never risk more than 1% of my account on any single trade. But I also use what I like to call liquidity-based position sizing. When I see multiple levels clustered together, what I mentioned earlier as liquidity confluence, I'll size up slightly because these setups often give me a very, very good risk to reward, meaning I'm putting in a little bit of money and I'm making a lot of money back. So it's okay if I'm using a little bit more money initially. On the flip side, when I'm trading a liquidity level that I don't have as much confidence in, I'll size down. It's not just about the dollar amount you're risking. It's about the quality of the setup and how much confidence you have in it. My stop losses are always placed just above or below a liquidity level, as I was showing you in some previous trade examples. I do this because, like we talk about, retail traders are always placing their stops right at these levels. So I like to place it right around these levels so I have a little bit of breathing room. I don't just place these stop losses at random levels though, guys. There's a science behind this. I analyze the market structure on the 1 minute, the 5 minute, and the 15-minute time frame. And what I do is I place my stop losses in areas where if it hits, I know that it would genuinely invalidate my thesis, meaning I am 100% wrong if this level gets hit. For take profit levels, I don't just target the first level and call it a day. I scale out of positions as price moves in my favor. For example, my first target might be the New York Open, second target could be the previous day's high, and the third target could be a round number or a weekly high or low. This allows me to lock in profits while still participating in the larger moves while they're happening. Remember that $10,800 day that I showed you? That was because I scaled out properly rather than taking all of my profits at the first target and then just calling it a day. The most important aspect of profitable trading is not the strategy itself, it's your ability to execute it consistently. Let me share the exact mental framework that allowed me to make $74,000 this June. First is my pre-market routine, and guys, this isn't some fancy Ashton Hall, Saratoga water, mango on your face thing. Every morning I follow the exact routine and it's super simple. I arrive at my desk at about 7:45 a.m. I spend the first 15 minutes marking out my levels, looking at previous price action, and just making sure I am prepared for the trading day. While I'm marking out my levels, I usually grab an energy drink or a little coffee just to get some caffeine in my system and wake me up. I also like to keep a water with a lot of electrolytes right next to my desk so I'm always super sharp. I then mark my levels using my session range indicator, which is the New York Open, London high and low, Asia high and low, and if there's any New York highs and lows that are nearby. I identify my potential liquidity areas and I make note of any zones that are looking really good because this could be a zone where I want to enter a trade off of. Now this is the part that separates the profitable traders from everybody else. Emotional detachment from individual trades. When I see a valid liquidity grab at one of my marked levels, I take the trade. No hesitation, no second guessing. When or if it hits my stop loss, I don't get frustrated, I don't try to revenge trade, I accept the loss and I immediately start looking for the next valid setups. When it hits my target, I do the same exact thing. I accept it. Trading is not about being right all the time, guys. It's about being consistently profitable year over year. My June results were not because I predicted every single market move correctly. Guys, remember, there were so many days where I decided just to not even trade at all. But because I followed my rules and I executed mechanically, on the days where my setups were there, I made a lot of money because I executed mechanically. So all of my winning trades made up for the days where I didn't make any money because I didn't take any trades. This is the difference between gambling and professional trading. Even with a profitable strategy, you'll have days, you might even have weeks where you don't see any trades to take, and that's okay, guys. From the 18th to the 23rd, I didn't take a single trade. That means over that period of time, I made $0. But I know that I'm going to make money over the long term, so I don't care about that. The key is understanding that this is normal and expected. Your strategy does not stop working just because you can't find a trade for a few days or maybe even a week or so. That's just the nature of probability, and as long as you stick to your system, the probabilities will work out over time and you will make money. Before I started trading this strategy with real money, I spent months back testing and forward testing this strategy on historical data and on the current data. I wanted to see how it performed in different market conditions. Trending markets, ranging markets, bull markets, bear markets, high volatility, low volatility. This backtesting gave me the confidence to execute so flawlessly now because I know that this strategy works. The reason that a lot of you guys don't have confidence is because you know deep down in your heart and in your mind that your strategy is not profitable. When you know in the back of your mind that your strategy has been profitable over hundreds and hundreds of historical trades, it is much easier to trust it during the inevitable losing streaks or just streaks where you don't take any trades. So let's recap. In the month of June, I made $74,504 and I took 11 trades, winning every single one of them. My average risk to reward was 1 to 4 and my biggest winning day was $10,800. These results are not luck or some unrepeatable hot streak. This is what happens when you follow a systematic and data-driven approach to trading. Every trade was planned, every entry was based on the same criteria, and every exit followed the same rules. If you want to learn this exact strategy in detail, I've put together a comprehensive training program where I will teach you everything. I will teach you how to identify liquidity levels, how to have the best possible entries and exits, how to manage risk, how to get to your first $10,000 month as a trader, and how to scale up to get to $20,000 to $30,000 months. And I will teach you the psychology that you need to execute consistently. In this program, I work directly with you. This is not some course. There's no buy now button. So if you want to see if you're a good fit for this program, hop on a call where it's going to be me and a member of my team talking with you to see if you're a good fit. And if you are, I'm excited to work with you and we're going to make a lot of money. If that is something that you're interested in, click the link in the description of this video and let's hop on a call. Remember, this is only for serious traders who want to get to $10,000 a month as a trader in the next 90 days. If you're not serious and if you're not a hard worker, I don't want you. Talk to you all soon. Thank you for watching.